Today we're going to talk about Chapter 6, Proved Property Cost Disposition using the Successful Efforts Method. We're going to cover DDNA, joint production of oil and gas, estimated future costs, and abandonment. DDNA is depreciation, depletion, and amortization. So if we can compare that to the different assets for financial accounting, we have our tangible property and equipment that's going to be depreciated. We have our intangible property that's going to be amortized. And we have our natural resources that are going to be depleted. So this is the expense that we're going to use for the asset losing usefulness. For the acquisition costs of the proved property, these are going to be amortized over proved reserves for our DDNA calculation. The cost of lease and well equipment is going to be amortized over proved developed reserves. And if we have proved undeveloped, these are going to be excluded. They're only going to be included as proved for leasehold costs only. This is our formula for DDNA. Effectively, we're going to adjust by using the estimate of our end of year reserves. Those are going to be the most up to date. And we're going to back into or calculate the estimated reserves at the beginning of the period. So you're going to have the book value at the end of the period. This is going to be divided by the estimated reserves at the beginning of the period. To calculate that, we're going to use our latest estimate reserves at the end of the period, plus we're going to add back our production. And then this number is going to be multiplied by the production for the period. Let's look at an example. Tyler Oil Company drilled the first successful well on Lease A early in 2012. The company plans to develop this lease fully over the next several years. Data for the lease as of December 31st are as follows. So we have our leasehold cost of $50,000, IDC for wells and equipment of $90,000. We have our lease and well equipment for $30,000. We have our production for the year, 5,000 barrels. We have our estimated proved reserves at the end of the year, December 31st, of 895,000 barrels. This is going to be used for the leasehold DDNA. And we have our estimated proved reserves recoverable from the well. So those are going to be proved developed reserves of 95,000 barrels. This is going to be used for the IDC and the lease and well equipment. So for our calculations, first we're going to calculate the reserves as of the beginning of the year. And as I mentioned, we're going to take the end of the year reserves. We're going to add current year's production to calculate the estimated proved reserves at the beginning of the year. So we're going to take estimated proved reserves of 895,000. We're going to add the 5,000 current year's production. So estimated proved reserves at the beginning of the year are 900,000. For the proved developed reserves, we're going to take estimated proved developed reserves at the end of the year of 95,000. We're going to add to that the current year production of 5,000. So our beginning of the year reserves are estimated at 100,000. Next, we're going to calculate using the unit of production formula that we looked at. So we have our book value at year end of $50,000. We're going to divide that by the estimated proved reserves at the beginning of the year of 900,000 barrels. And then we're going to multiply that times the production for the year of 5,000 barrels. So we're going to get $278. So this is going to be our DD&A expense for leasehold or approved property. For the proved developed reserves, we're going to take the book value at year end of $120,000. We're going to divide that by the estimated proved developed reserves at the beginning of the year, which is 100,000 barrels. We're going to multiply this times the 5,000 barrels and we're going to get DDNA expense for our approved developed for our wells and equipment of $6,000. Looking at our journal entry, we're going to debit DDNA expense approved property for $278. We're going to debit DDNA expense for wells of $6,000, and we're going to credit our accumulated depreciation. So we have accumulated DDNA for approved property of $278 and accumulated DDNA for wells of $6,000. So this example was using and calculating it based on the first year. Now we're going to look at another example for a continuing lease. So this will be not the first year. So for our cost data, we have our lease bonus of $490,000. We have other capitalized acquisition costs of $50,000. So total leasehold costs at year end are $540,000. So if we subtract the accumulated DDNA at the beginning of the year, we're going to get a book value of $500,000. We're going to do the same calculation for IDC and lease and well equipment. We're going to take the IDC at year end of $650,000. We're going to subtract any accumulated DDNA on IDC already recorded of $120,000. So we're going to get a book value of $530,000. On our lease and well equipment, at year end we have $275,000. We're going to subtract our accumulated DDNA already recorded of $50,000 to get a book value of $225,000. Now this is our end of year reserve information. So we have estimated proved developed reserves at the end of the year of 1,750,000 barrels. We have estimated proved undeveloped reserves at the end of the year of 2,200,000 barrels. And we have our production during the year of 50,000 barrels. To calculate our DDNA at the end of the year, we're first going to look at and calculate using our estimated proved developed reserves at the end of the year, 1,750,000. We're also going to add the estimated proved undeveloped reserves of 2,200,000. We're going to add these together to get a total of 3,950,000. And this is going to give us our total proved. So it's going to be the developed and the undeveloped. We're going to add our current year production of 50,000. So our estimated proved reserves at the beginning of the year are 4 million. Our proved developed reserves, the end of the year was 1,750,000. We're going to add the current year's production of 50,000 to calculate our beginning estimated proved developed reserves of 1,800,000. So I've written here above the book value that we calculated on slide 10. We had the book value for leasehold of 500,000, IDC of 530,000, and lease and well equipment of 225,000. So next we're going to use these amounts that we've calculated to calculate our DDNA. So for proved property costs, we're going to take the 50,000 current year's production divided by estimated proved reserves of 4 million barrels. We're going to multiply this times the book value at year end of $500,000. So we're going to get an amount of $6,250,000 for DDNA expense. You can see the formula has actually been rearranged. It doesn't matter which one you use. To calculate it for wells and equipment, we have current year production of 50,000 barrels. We're going to divide that by the estimated proved developed reserves at the beginning of the year of 1.8 million barrels that we calculated. And then we're going to multiply this times the book value. The book value for IDC is 530,000. So we're going to get DDNA of $14,722. And then we can multiply it by the book value for lease and well equipment of $225,000 to get DDNA for $6,250. So if we add the three amounts of DDNA expense that we've calculated, we get a total of $27,222. And this is our journal entry. So we're going to debit DDNA expense for $27,222. We're going to credit the accumulated DDNA for each category. For approved property is $6,250. For IDC is $14,722. And for lease and well equipment is $6,250. Now we're going to talk about joint production. So if you have a lease and you are producing oil and gas, you can convert it to an equivalent based on the relative energy content. So these are going to be given to us. So these are the basic equivalents that are used. So there's three methods. There's the common unit of measure. You're going to convert to a common energy unit. So it could be to oil or gas. You can use the same relative proportion of oil or gas, or if you have one of the minerals is dominant, you can use that one. The actual relative energy content is 6. So if you have barrels of oil equivalent, we're going to use that as BOE. Equivalent MCFs, that's million cubic feet that gas is measured in. So you're either going to take your MCFs and divide them by 6, or you're going to take your barrels of oil and multiply them by 6. So our example is on page 192. We're going to use a common unit of measure of barrels of oil equivalent for the oil. So assume a producing lease has both oil and gas reserves, and DDNA is calculated on equivalent barrels. So we have our net capitalized costs of $2,200,000. We have estimated proved developed reserves. Our oil is 400,000 barrels. Our gas is 1.8 million cubic feet. We're going to take the 1,800,000 MCFs. We're going to divide that by 6 to calculate 300,000 barrels of oil equivalent. On our production, we're going to do the same thing. We have oil of 50,000 barrels. We're going to convert our gas of 240,000 MCFs divided by 6 is going to give us 40,000 barrels of oil equivalent. So now we're going to add them together. So we look at our production during the year. We have our oil of 50,000 barrels. We're going to take our gas, 240,000 divided by 6, to calculate 40,000 barrels of oil equivalent, and we add those together to get 90,000 barrels of oil equivalent. On our reserves, we have oil of 400,000 barrels. We're going to take our gas of 1,800,000 divided by 6 to calculate 300,000, and we're going to add those together to get 700,000 barrels of oil equivalent. So we're going to use these numbers in our DDNA calculation. So we have our net capitalized costs of 200,000. We're going to divide that by the proved developed reserves of 700,000 barrels of oil equivalent plus our production of 90,000 barrels of oil equivalent. We're going to multiply this times the production of 90,000 to give us DDNA expense of $250,633. Now we're going to talk about estimated future costs. So these are costs that are necessary. They will be incurred, so we're going to use them in our DDNA calculation. So at the end of its life, a property will incur future decommissioning costs such as dismantlement, restoration, and abandonment costs. We're going to call these AROs, Asset Retirement Obligations, and we're going to add them to our DDNA calculation over the life of the asset. You may abandon or retire a well or portion of a property. So note that a gain or loss is not recognized until the last well ceases to produce and the entire amortization base is abandoned. So that would mean you're abandoning the entire property. Until that time, you're going to treat as fully amortized and charge it to accumulated DDNA if you abandon a well. So we're going to look at an example on page 207. Tyler Oil Company abandons the lease with capitalized acquisition costs of $70,000 and capitalized drilling and equipment costs of $200,000. Equipment worth $30,000 was salvaged. The lease was part of a field that had total accumulated DDNA for proved property of $300,000 and total accumulated DDNA for wells and equipment of $500,000. This lease was not the last producing lease in the field. So we're going to look at two things. First, we're going to determine the amount to be salvaged, and then we're going to write off the asset and accumulated DDNA. So the materials and supplies are considered to be salvageable. So we're going to debit that account for $30,000. We're going to write off the asset. We have proved property of $70,000 that we're going to credit, and we're going to credit wells and equipment for $200,000. So as you can see, we're going to debit accumulated DDNA for the proved property of $70,000 and the difference between the wells and equipment amount of $200,000 and the amount that we capitalize as materials and supplies of $30,000. We're going to debit accumulated DDNA for wells of $170,000. Again, you will note there's no gain or loss because this was not the last producing lease in the well. We are simply writing off the asset, including setting up any amount that can be salvaged. Alternatively, if the lease was the last producing lease in the field, all other properties have already been abandoned, the balance in accumulated DDNA for proved property was $65,000, and accumulated DDNA for wells and equipment totaled $155,000. So again, we're going to be determining the amount to be salvaged. We're going to write off the asset. Then we're going to remove any accumulated DDNA. And if there's any extra, it's going to go to expense. So building our journal entry, the amount to be salvaged of $30,000, we're going to debit materials and supplies. We're going to write off the asset next. So we're going to credit proved property for $70,000, and we're going to credit wells and equipment for $200,000. Next, we're going to remove any recorded accumulated DDNA that's remaining. So we're going to debit accumulated DDNA proved property for $65,000. And we're going to debit accumulated DDNA for wells of $155,000. We have a remainder of $20,000. This is going to be debited to surrendered lease expense. Now we're going to look at a comprehensive example. You can find this on page 209. So on February 2nd, Tyler Company acquired a lease burdened with a 1/6 royalty for $100,000. The property was undeveloped and the acquisition costs were considered to be individually significant. So we're going to debit unproved property for $100,000 and credit cash. On February 2nd, a delay rental of $3,000 was paid. So we're going to debit delay rental expense of $3,000. Several dry holes were drilled on surrounding leases during the year. As a result, Tyler Company decided the lease was 40% impaired. So we're going to take the 100,000 times 40%. We're going to debit impairment expense for 40,000, and we're going to credit allowance for impairment of 40,000. During 2013, Tyler Company drilled a dry hole at a cost of $350,000 for IDC and $35,000 for equipment. No equipment was salvaged. So we're going to debit wells in progress IDC for $350,000 and wells in progress lease and well equipment for $35,000 and credit cash for $385,000. So that would be the initial recording of the costs. When it's determined that it's a dry hole, we would debit dry hole expense IDC for $350,000. We would debit dry hole expense for lease and well equipment of $35,000. And we would credit our wells in progress IDC that we've recorded of $350,000. And we would credit our wells in progress lease and well equipment for $35,000. So this would be reclassifying the wells in progress that we have recorded to the dry hole expense. Next, Tyler Company drilled another exploratory well in February at a cost of $500,000 for IDC and $175,000 for equipment. The well found proved reserves. So the initial entries are going to be to debit wells in progress IDC for $500,000 and wells in progress lease and well equipment for $175,000. When we complete the well, we're going to reclassify these amounts to wells and equipment for IDC of $500,000 and wells and equipment lease and well equipment for $175,000. We're also going to reclassify our property from our unproved property of $100,000. We have to write off the allowance for impairment of $40,000. So the amount that we're going to capitalize to the proved property is $60,000. Here's our T account showing the amounts that we've recorded to date. Proved property of $60,000. We have our wells and equipment IDC of $500,000 and wells and equipment lease and well equipment of $175,000. So to continue, a total of 12,000 barrels of oil was produced from the successful well during 2013. Related lifting costs were $4 per barrel. So we're going to take the $4 times the 12,000 barrels, and we're going to debit lease operating expense for $48,000. During December, Tyler Company began drilling a third exploratory well. Accumulated costs by December 31st were IDC of $100,000 and equipment costs of $15,000. These are going to be recorded to the wells in progress accounts. At the end of the year, the reserve report as of December 31st and production during 2013 for Tyler Company are as follows. We have proved reserves of 900,000 barrels, proved developed reserves of 300,000 barrels, and production of 10,000 barrels. So to calculate our DDNA expense, for the acquisition costs of $60,000, we're going to divide that by the proved reserves plus production, so 900,000 plus the 10,000 barrels, times the amount of production of 10,000 barrels gives us $659. For wells and equipment, we had $675,000 recorded. We're going to divide this by the proved developed reserves of 300,000 barrels plus 10,000 production. And we're going to multiply this times the production of 10,000 barrels. That gives us $21,774. So our journal entry to record the DDNA expense is DDNA expense for proved property of $659, DDNA expense for wells of $21,774, and we record the accumulated DDNA for proved property of $659 and for the wells of $21,774. So you can see I've updated the T accounts to show the amounts that were recorded to accumulated DDNA to date for approved property and for wells. During 2014, Tyler Company completed the third well at an additional cost of $300,000 for IDC and $175,000 for equipment. The well was successful. So the initial entry to record these costs are debit wells in progress for IDC and lease and well equipment. And then we're going to reclassify the amounts from wells in progress to the actual asset accounts. So we're going to debit wells and equipment IDC for $400,000. And we're going to debit wells and equipment lease and well equipment for $190,000. We're going to credit wells in progress IDC for $400,000. And we're going to credit lease and well equipment for $190,000. So to update our T accounts, you can see on the left that I've added the amounts capitalized to the wells and equipment IDC and wells and equipment lease and well equipment accounts. During 2014, a total of 36,000 barrels of oil was produced. Related lifting costs were $5 per barrel. So we're going to multiply the $5 times the 36,000 barrels, and we're going to debit lease operating expense for $180,000, and we're going to credit cash for $180,000. Now to calculate our DDNA at the end of the year, the end of 2014, we had proved reserves of 1,470,000 barrels, proved developed reserves of 970,000 barrels, and production of 30,000 barrels. So the DDNA calculation for acquisition costs. We have our 60,000 capitalized minus the accumulated DDNA of 659 gives us our book value. We're going to divide that by the proved reserves of 1,470,000 barrels plus the production of 30,000 barrels, and we're going to multiply that times the production of 30,000 barrels to calculate $1,187. For wells and equipment, we're going to calculate the book value. So again, we're going to add the asset amounts that are capitalized, $675,000 plus the $590,000, subtract the accumulated DDNA of $21,774. We're going to divide this by the proved developed reserves of 970,000 barrels plus production of 30,000 barrels. And we're going to multiply this times the 30,000 barrels to give us $37,297. To record our journal entry, we're going to debit DDNA expense proved property, $1,187. Debit DDNA expense for wells, $37,297. And then we're going to credit accumulated DDNA proved property, $1,187. And credit accumulated DDNA for wells of $37,297. So here are our T accounts updated for the amounts that were recorded to accumulated DDNA for both proved property and for our wells and equipment. And a disaster struck and Tyler Company abandoned the lease. No equipment was salvaged. So first we're going to write off the assets. So we're going to credit our proved property account for $60,000, our wells and equipment account IDC for $900,000, and wells and equipment for lease and well equipment of $365,000. You can get all these amounts from the previous slide in the T accounts. Then we're going to write off any accumulated DDNA. We had accumulated DDNA for proved property recorded of $1,846 and for our wells of $59,071. The remainder is going to be debited to surrendered lease expense for $1,264,083. That's recording the loss on the property. And this concludes Chapter 6.